Picture starting your investment journey in 1985. For a couple of years, your money steadily grows. Then, Black Monday hits. Wall Street suffers its biggest one-day drop in history, and people urge you to sell everything. You ignore them. Slowly but surely, the market recovers, until the dot-com bubble bursts. The Nasdaq goes into a freefall, and friends are begging you to pull your money out before you lose it all. This line graph shows the massive V-shaped dip and immediate recovery of the 2020 global economic contraction. The global economy suffered the worst downturn since the Great Depression, but as things reopened, the market rapidly set new records. This chart visualizes exactly what happens if you weather those storms. If you had invested just $250 a month starting in 1985, letting the historical average return compound year after year, your portfolio would sit at over $1.8 million today. By the end of this video, you will move from a beginner to an active investor with a fully automated portfolio running right from your phone. But before you deposit a single penny into the market, you need a safety net. You must build an emergency fund covering 3 to 5 months of living expenses in a standard bank account. Surviving a highly volatile market requires that cash buffer. Once it is firmly in place, you can confidently invest, knowing that ignoring the market out of fear will cost you millions over your lifetime. Step 1 is setting up your account, and this is where beginners often make a costly mistake. If you open a standard trading account, you will eventually lose a significant chunk of your profits to capital gains tax. To prevent that, you need a tax-advantaged account. If you're in the UK, open a stocks and shares ISA, which lets you invest up to £20,000 a year tax-free. If you're in America, select a Roth IRA. Once your account is open, navigate to the deposit screen. Most modern investment apps make this straightforward, allowing you to fund your account instantly using options like Apple Pay or a direct bank transfer. Keep an eye out for promotional codes when you do this. Many platforms offer free starter stocks just for making your first deposit. Getting this account structure right legally shields decades of compound interest from the taxman. It is the highest return decision you will make today. Now we need a winning strategy. Picking individual stocks that consistently beat the market is highly difficult, so our strategy is simpler. We are going to buy the entire market. Think of the stock market like the music charts. The best-selling songs and massive bands like Queen rise to the top of the list. If a song drops in popularity, it falls out of the charts entirely. An index fund works the exact same way with companies. The S&P 500 is essentially the ultimate music chart for the United States economy. It tracks the 500 largest public companies, continuously filtering out the losers and promoting the winners. In your app, locate the Portfolio Creation tab, often called PIES, and search for an S&P 500 index fund. With one click, you spread your investment across all 500 companies. You will likely see two options, distribution or accumulation. Always select accumulation. This ensures that any dividends those companies pay out are automatically reinvested back into the fund to buy you more shares. Next, turn on the Auto Invest feature. Set it to a small, manageable amount you won't miss from your bank account, like the daily cost of a coffee, and let it run. This projection tool shows why this daily habit matters. Based on historical averages, a continuous investment of £250 a month expands to over £3.5 million over a 40-year timeline. By pairing an accumulation fund with automated monthly deposits, you completely remove human emotion and calculation errors from your wealth-building process. While your index fund runs automatically, you might also want to allocate a small percentage of your cash to individual companies you believe in for the long haul. Use the search function in your app to find a specific company you've researched, like Tesla, and select Buy. When the order screen pops up, you face two main options: market orders and limit orders. A limit order is like going to a boot fair and haggling. You specify the exact price you are willing to pay, and the trade only executes if the stock drops to that number. A market order is like walking into a supermarket. You pay whatever the current sticker price is. As a beginner, stick to market orders. Type in the amount of money you want to invest, hit buy, and the app executes the order immediately. Holding individual shares is highly engaging. But remember that the bulk of your financial future rests safely in the automated index fund you just built. If you followed these steps, you are officially a part owner of some of the most profitable corporations on Earth. But you need to prepare yourself right now. Market crashes are a guaranteed feature of your investing lifetime. Your portfolio will drop, and the financial news will sound disastrous. When the crash happens and the people around you panic, stick to your strategy. Keep your automated deposits running and let compounding do the heavy lifting. This area chart compares two identical investment strategies, but the bottom curve started 10 years later. That massive gap in the middle represents the exact financial penalty of waiting. Time in the market is your greatest asset. Now that your long-term foundation is built, the next step is accelerating your growth. Click this video to see exactly how the math works once your net worth scales past your first $100,000.